Taxes are a necessary part of today's society, but it does not have to be a part of your overall wealth plan. You see, with a little planning today, we can actually work to lower your overall taxes, and in doing so, we can create new streams of income that is tax-free and can be working to better your overall wealth plan, as well as the ability for you to pass on assets. All of these things are possible when you know what accounts you have and where you can be going with each individual account and how they can work to lower your overall taxes. Hey, it's Nathan Krampe, and I create these videos because you are very ambitious when it comes to your overall wealth plan. But you know there is more out there. You want to create an impact for your family, yourself, as well as the community with your wealth. And to do that, you want to learn about great strategies. Today, we are going to be looking at strategies that employ tax-deferred accounts, tax-free accounts, as well as taxable accounts, and the differences between them and how you can be utilizing them to help lower your overall taxes and to help improve your overall wealth plan, not only today, but in retirement. Let's dive into the different details of taxation. Now, before we get to the different types of accounts, there's one main reason why we want to be looking at this. You see, when we take a look at the taxable accounts, the tax-deferred accounts, and the tax-free accounts, there's going to be different strategies and ways that we're going to be utilizing each one of those accounts. You see, it may be worth it that we put money aside today for the future that's going to lower our taxes today. Well, we may have other monies that we want to be taking from that's going to have a lower tax burden in the future. Or it may be vice versa. We want to take a lower tax burden today so that we can have a higher tax burden in the future. You see, there's not one right element to any of this. It comes back to where you're at with not only the tax brackets, what you're looking to accomplish, all the different types of strategies that there are out there. And what we can do is, once we know the different strategies for you, we can start to employ the different changes to help improve your overall wealth plan. So that looks to improve the probability of success, that the money that you have set aside in all of those different areas is not only going to grow, be there for your own retirement, your own benefits, but also to help improve the lives of not only the people you care about, but the organizations and communities that you care about as well. So that's the piece of it. Now, the other element that we want to be talking about here is how to lower your taxes. And if we can do that correctly, we can improve your overall wealth plan and we can be lowering your taxes. That is a recipe for success. Now, that is something that is not just built ingrainedly into our tax code or into your wealth plan. So we have to be going through different strategies, and what we want to be talking about today are the different ways we can be putting money aside and how to best utilize them in the future. I want to start with taxable accounts. Now, taxable accounts, or as I like to call them, tax me now type of accounts, those are ones that are bank accounts, savings accounts, CDs that you may have, even your brokerage account, jointly held account, individual accounts. Those are all considered taxable accounts. Now, why is it that they're called taxable accounts? Well, first and foremost, it's because of the fact that basically this money will be taxed in the year that you have gains, that you have realized gains, or interest or dividends that have been paid out. So that really comes back down to where you're having your money invested and how it is invested. You see, there are many different types of investments that are out there that are going to be paying dividends, paying interest along the way, and that may be a great strategy for you. But the thing that you need to remember is that that is taxable as well. And what ends up happening is that if we are growing the accounts, but every single year we are paying tax on that growth, or the interest or the dividends that accumulate off of that, well, those really start to lower the overall growth that's happened on that account in general. So it could be a bank account, or it could be your investment accounts. Well, you see, all of those have different strategies and reasons for you to be invested into them, but the taxation is always in the year that we had the growth happen, that we had the realized gains, that we had the interest, the dividends, things like that. And if we can look to use that specifically for certain elements, not only in the near term, but also elements in the future, we can actually be looking to lower your taxes as well. So even though this is a taxable account that has the potential to have tax every single year, it comes back to the investments. And if we can really look to work with those investments correctly, maybe ones that don't pay dividends or don't pay interest, or maybe ones that have a lot of ways to grow without having realized gains that happen in them. All of those strategies can be very useful for this type of an account. So we're going to come back to this as part of the planning strategies, how we can be utilizing them together. But just know this, that those taxable accounts are taxable in the year that we have the gains, the interest, as well as the dividends. Retirement plans are the next element that we want to be talking about. You see, retirement plans are unique. They are something that's set up from your employer. So whether it is from your employer and you're the executive and receiving compensation through those plans, or whether you are a business owner and maybe you are actually having some of your own profits be directed into the retirement plans. These are great and very specific elements that you can be utilizing to put money aside for the future. Now that is the key element to the retirement plans, whether it is a 401k, 457 plan, 403b, all of these different types of plans have one thing in common. It's a way that instead of taking all of this money today, that you can be setting some of the money aside for the future. Now that money that you set aside for the future will be used for income, basically in retirement. Now that income then is something that is going to be taxable. So even though it is not taxable to you today, it's called tax deferred, it will be taxable to you in the future. Now that is also part of what you call the required minimum distributions. So these types of accounts are going to have a minimum amount that's going to be taken out in the future by law, basically. And this law has been changing. So a part of the new Secure Act 2.0 laws and rules that have come out is that we are changing that age. So no longer is it 70 and a half. No longer is it 72. Now the age has been pushed back to 73. And for those of you that were born after 1960, it has actually changed to be age 75. So what you're seeing is you can basically defer taking the money out longer and holding it in these types of accounts. So that is, first of all, great news because of the fact that it gives you different options. So if the government is saying we are not mandating that you take money out of these accounts quite as quickly, well, now you have options to say, well, what can I be doing to lower your tax burden not only today by putting money into these accounts, but tomorrow of how you're taking money out of these accounts. So that's really the crux of the new type of planning that you can be going through here. And really when it comes down to how we're working with these accounts, what we want to do is put money into them, set them aside, but then figure out ways that we can be taking money out, paying a little tax on it, but converting it and putting it into those tax-free buckets in the future. Well, there are many elements that have changed when it comes to how we can do that. First of all, contribution levels are continuing to go up, as well as there is a brand new element to catch-up provisions if you're 60, 61, 62, or 63. Now, I understand, those 4 years only. But what this allows you to do is put extra money from your paychecks away into your retirement plans. Also, if you are making more than $145,000, those catch-up provisions that we have, you may have to be directing them to the tax-free buckets as part of the Roth IRA. Now what that does is say that they have to be taxable today, but they will grow tax-free in the future. So many elements that have changed here when it comes to your retirement accounts, but the biggest element, put money away into these types of accounts so we can be utilizing them for the future. And in that window from your retirement all the way through when we are working to take required minimum distributions, those are the windows that we have to make some changes in the accounts so that you can actually look to lower your overall taxes, not only in retirement, but for the future. So retirement plans have a big part of your overall wealth plan. Speaking of retirement accounts, there are many different types of retirement accounts that you can be contributing to on your own. Now, there is specifically the traditional IRA account that acts a lot like one from your employer, like a 401k, but this is something that you can be putting money aside into these types of accounts that are going to be growing tax deferred in exactly the same manner that the 401k, 403b are. But there's the other element that you are well aware of, the Roth IRA. That's the tax-free growth that is happening off of those types of accounts. So the money goes in there on the same way. It can go into these types of accounts, but the growth is either tax-free or tax-deferred. Now the differences obviously are when you pay for the tax. So whether you pay for it today as part of the Roth IRA or get a tax basically benefit for putting the money aside into these accounts, there are some different ways that you can be utilizing them for yourself for the future. Now, if you just have money set aside in a traditional IRA or your traditional 401k, it would be worth it to actually add in an element of the Roth IRA and the Roth 401k. Now, that's obviously a really good strategy to start utilizing both buckets. So we can be putting a little bit of money aside that's tax deferred that we will have to pay tax on in the future. But if we pay a little tax today and put some money aside for the future that will be growing tax free, that also is going to be adding a benefit to where the money comes from in retirement. So utilizing these strategies are going to be really profound and impactful in the future. And that's, again, the reason why we want to be talking about this, because there's different ways that we can be putting money aside, but then the best element is how we can be cherry picking which accounts we can be taking from in the future. Now, a specific word about the Roth accounts, especially the Roth IRA, there is a window of time we need to have these accounts open, which is a 5-year period, in order for you to say, I can be taking money out of this without having any taxation. So this is pertaining to the growth of the account. So if we are putting money in today to open the account, but then we pull money out tomorrow, there is a chance that you would be having a penalty on that growth, taxation on that growth. But if the account is established for 5 years, then we don't have anything to worry about there. So that's one of the main reasons why we actually should be putting money aside into these accounts, even if you're young and don't exactly have the money to be putting aside right now. You can actually just put a couple dollars into them, get it started, and then that can be better used for the future as well. Okay, well, if you're an executive and all of your compensation is going into your qualified accounts like your 403b, your 401k, or maybe it's going into paying for more stock options, well, those are all pieces of either the tax deferred or the tax me now accounts. And it may be beneficial for you to start using the Roth 401k, the Roth IRA accounts, to start putting some money aside as well. You see, again, when we start to use those elements, and this comes back to your own wealth plan. So we cannot be just saying we need to be going into all of them without taking a look at where you're at today and where you want to be going in the future. But that Roth account, whether it is the IRA, the 401k accounts, those are great benefits for the tax-free elements. And when we start looking at doing Roth conversions in the future, taking from that tax-deferred account and placing it into the tax-free account, well, now we have the ability to even right the ship of the taxes more, and to make sure that we can be lowering your taxes today, tomorrow, in the future as much as possible. So that's the power of the Roth account and why we want them a part of your overall strategy. Let's wrap up the Roth discussion with one specific element that has not changed, and that is the backdoor Roth. You see, for those of you who are over the income limits, sometimes a Roth IRA is not something that we can be putting money into. Well, specifically, there were some loopholes that have not closed, and that would be to put money into a traditional IRA, but we are not claiming the deduction on that. So what that will allow us to do then is to take that money and convert all of that into the Roth IRA. Now, there are some limits here that you need to be aware of when it comes to having multiple IRA accounts open and how much we can be converting that would be subject to tax or not taxable. But if done correctly, then that means that all of the money that we put into the traditional IRA, and again, we did not take the deduction for it, but that could be converted into the Roth IRA. And if we do that, that's a great way of saying we don't potentially have to owe tax on it, but we can be putting money into that Roth IRA account now that will grow tax free. So this is very helpful. Let's say if we have not only the Roth account we want to be putting money into, but we have your employer plan as well. So maybe we do have some traditional 401k money or Roth 401k money that we're setting aside, but you want to set aside extra amounts. So if you are wanting to do that, a lot of times that Roth IRA piece would not be eligible to be put money into if you are over the limits. So this allows us to do so. And that again is the power of the tax deferred and tax free options that we get with the Roth IRA of how we can be growing the money for the future. But the nice thing, again, that this has not changed with the new Secure Act 2.0. Another element that we want to be talking about is the after-tax 401k. You see, we talk about the traditional 401k a lot, and that is really when we put money aside from your paycheck that is not taxable and goes into an account that is growing tax deferred. But we also have the Roth 401k that we've been talking about as well, and that one specifically is saying we're going to pay tax on your income today before we put it into your Roth IRA account to grow tax-free. But there is another element, another type of an account, the after-tax 401k. Yes, we pay tax on the money before it goes into your 401k, and it grows tax deferred, but it's not tax-free like the Roth. So why would we want to be doing something like this? Well, again, it comes back down to the different tax buckets that we have. And let's say that we put an amount of money, let's say $100,000 over the years into this after-tax 401k. Well, again, that's your basis. So it's acting like a taxable account. Well, the growth is tax deferred. So we don't have to pay tax on a yearly basis on the growth of that account. And what we know is that if we had a taxable account with that basis, that's helping you today because we don't get taxed on that basis. But the tax deferred element is helping your money to grow faster. So we have a tax deferred element that we are not getting taxed on today, but we will get taxed on in the future. We have a tax-free element that we are taxed on today, but it has a tax-free element in the future. But we also have a certain piece of it that is going to be taxable today. So we have the basis, but that's going to grow now to be having only taxable on the gains that we have in the future. So those different elements are going to be very helpful, and that's the reason why you should actually be looking at having the after-tax 401k as a piece of your overall wealth plan as well. Well, let's take a step back and let's go back to the beginning when we talked about the taxable account. You see, the after-tax 401k is great, but that's tax deferred money, so we still don't have to be working and worried about the investments in there nearly as much. But those taxable accounts are different. The taxable accounts are the ones that we have to be worried about what investments and interest rates are as part of there, because all of that can be taxable on a yearly basis. what we want to look at, and part of these types of accounts are looking at the differences of the investments. So we don't want ones that are going to be paying capital gains, especially short-term capital gains, if we can help it. We don't want ones that are going to be paying a lot of dividends or interest, if we can help it. And there are specific tax benefits to some types of investments that we can be putting into these accounts that will actually be beneficial to you, so that we can defer those taxes as long as possible. And like I said before, that when we talk about the tax deferral, that is one way that we can be growing your overall wealth faster, is by deferring those taxes. So a great element that you can be utilizing when you are working on these types of investments is to pick ones that are going to be efficient when it comes to taxes. Next stop here, we're going to be talking about the HSA, or the Health Savings Account. Now this one is very specific. This is one that you can be setting aside money into, especially if you have the high deductible plans. Now what you can be doing is setting aside money into here, and specifically for many of you, you can have it actually deducted from your paycheck. Now the nice benefit here is that it's going to go in before taxes. So think of it like another savings account, just like a 401k, but it's not going to be used for retirement. It's going to be used for your healthcare needs. Well, money goes in there without being taxed. Money grows tax deferred. So again, it's exactly like your 401k. But the difference being, if you use it specifically for your healthcare needs, you will not be taxed when it comes out. So this is a great element because it's what I call a triple tax benefit. So we have the taxation that's not going to happen when the money goes in. We have the taxation that's not going to happen on the growth, and we have the taxation that's not going to happen when you take the money out. So all of those elements make it a triple tax free type of account. And this is one of the only types of accounts that you can place money into that has this type of incredible tax benefit. So when we take a look at where we should be directing different elements of your overall wealth, the HSA account is going to be a very, very helpful place to direct as much money as you can when you need it for not only your health today, your insurance premiums tomorrow, but maybe even taking a distribution or out of there for use as part of your paying for some of your healthcare related needs in the future. One element now that has been getting a lot of press over the last 20 years, and I would actually say a lot of negative press over the last about 20 to 30 years, are annuities, and specifically tax deferred type of annuities. Now, there are many different elements to annuities, and I would really suggest that you start at least looking into them more, and don't take the opinion of just a couple different individuals. I know there are some very, very prominent people that are out there that are talking against annuities. Well, what they're really talking about is the fact that there are many annuities that are high in fees. Now, if we start doing your research and start looking at some different types of annuities, you can find some that do not even have fees attached to them. You can find ones that are incredibly low in fees, and you can also find ones that are going to be very beneficial for securing guaranteed income streams. Now, why is that important? Especially when we talk about your retirement. And the statistics have shown that the quality of your retirement, and I don't care if you have $100,000 to your name or $100 million to your name. It's not about the fact that you have the zeros in your bank account. It's not about how much money you have. It's how much guaranteed lifetime income that you have that's going to help you through retirement. So yes, things change and planning changes with how much money and how much wealth you have. But really what it comes back down to is your quality of life and how to secure more guaranteed streams of income. And that's when an annuity comes in. Now again, there are different types. There are ones specific for IRA accounts. So maybe we want to be putting money into those types of investments for growth as well as for that income stream that it can provide. but there are other elements that are out there. One specific is what we call the tax deferred annuity. So this acts like that part of the 401k that we were just talking about. That is, money goes into this account, say from your checking account. So we put $100,000 into here. Now that's after-tax money that is going to grow tax deferred. So we are taking that tax element out of there. And again, there are not many vehicles or ways that we can be investing that can do this with after-tax money. So this is a great way that you should at least be looking into if we want to secure more tax benefits today. But that may be an expense of the future. So again, we'll have to be looking into this more and more. But the nice element is that we can be taking that money and now we can convert it into not only growth as tax deferred, but we can also be converting it into streams of income. And a lot of times you can be paying out a higher stream of income for yourself, for your spouse, and for your family than what you could have if you had just kept it in the original investment vehicle that it was in. So annuities are very powerful, and I want you to be taking at least a look into them when it comes to how much income that you need. And this comes back down to your happiness. This comes back down to living a less stressful life when you have those guaranteed streams of income. And that's exactly the reason why annuities may be a great piece and an element to your overall wealth plan, but should be taken as part of doing your due diligence, the planning side of it, and understanding how it will fit in. Well, your overall wealth plan is not going to be complete unless we start talking about how we can be passing on money to your heirs as well. And specifically, you may not want to be passing on money that can be directed towards anything. You want to be specific, to be used maybe for college or for schooling. And that is the nature of the 529 plan. Now, you are probably well aware of those plans, but one element has changed as of the new Secure Act 2.0 that I want to be highlighting here. And that is the ability to convert from a 529 into a Roth IRA account. Now, why this is going to be very helpful and beneficial for you is because of the fact that for you, probably with your children or your grandchildren, maybe they get scholarships. Maybe they actually are going to go into a program that's going to start paying for their schooling. And you have all this money set aside that's to be used for schooling that now cannot be because you have such a great benefit that was given to you with some of these scholarships or some of the ways in which you are having reduced tuition. Well, what can we do with that 529 plan? Yes, we can convert different beneficiaries so that we can be using that money towards others, but what if we want to keep everything equal between your grandchildren so that there's no infighting? We don't want to necessarily take one 529 plan and just direct it to another. Well, we can actually now take that money and put it aside into a Roth IRA designated for that same beneficiary. So maybe that is your grandchild. Well, that's going to be saying that instead of being used for school, now it can be for tax-free elements in the future for retirement. That is going to be a very powerful element for the 529 plans. But the best thing you can do is put money aside today for school. If it's not needed, let's talk about different options you have to convert it into a Roth IRA for them. Okay, when we talk about tax-free income, tax-deferred income, and taxable income, we really have to basically be talking about a lot of different types of investments that you can be invested into that will help to grow, but one is often overlooked. You see, we've talked about the annuities a little bit, about just investing into accounts in a tax-efficient way by investing into your 401k accounts, yes. But life insurance can actually be used as an investment vehicle as well. And you see, there are many elements of life insurance that can be really useful when it comes to making sure that we can have a death benefit in the future, but also we can be utilizing that money today if needed. So what that looks like then is we can be putting money aside into these types of plans, especially one that accumulates the cash value. Well, that again can be used as a death benefit. But what happens if you need some income? There are many policies now that actually can start providing income streams to you in retirement. And that can be tax-free. You see, with the specifics of life insurance, and again, this is unique to life insurance, we can take tax-free loans out of this account. Well, yes, that may reduce the death benefit. Yes, that may reduce the cash value. But maybe that's the whole point. And so life insurance, while it's be using to guard against your death and your passing, can also be utilized as well in your retirement to make sure you have a great retirement. So don't overlook the benefits of life insurance as part of your overall wealth plan, not only to pass on money, but also how to be using it correctly as part of your overall wealth plan. Real estate is the next endeavor that you can have as part of your overall wealth plan. Now, there are many different ways to look at real estate, and there's many different ways that you can have tax benefits. You see, we can have more liquidity and have a real estate investment trust as part of your overall portfolio. Well, that's going to provide a lot of different types of dividends and interest, as well as liquidity. But it's not going to provide all the tax benefits as if you had just been able to purchase a building outright. So the benefits of that then would be that if you took some of your money, put it into buying a building, where you have deductions, you have write-offs, you have those types of elements, but you can also be changing buildings by doing 1031 exchanges as well. So there are different utilizations. Now, the worst part about that is that when we take a look at how to put money aside into a building, it ties up your money. You don't have the liquidity of it. So that's where REITs, real estate investment trusts, come into play. But again, when we take a look at the positives and the negatives of each, it really comes back down to what the money is going to be used for and how it's going to be used as part of your overall wealth plan. But real estate has a very big piece to play in your overall wealth plan when it pertains to how we can be tax advantageously growing your overall wealth. Now, every good strategy will come back down to charity as well, because when we look at different elements of charity, that's a great way to receive a deduction. So if we gifted cash to a charity, we can receive a deduction. And if we are over those standard deductions, well, that is a great way now to say you can actually be lowering your taxes. But there's many different elements that we can be going into from here. And one of the best abilities that you can have are creating different types of basically charitable trusts. Whether it's one that can pay you income actually in retirement, and then the remaining portion goes to charity, or whether you actually are giving some of that elements and some of that money to charity today, but then you're going to be gifting some of the remaining pieces of that trust to your children in the future. You see, there's a lot of great things that we can do here. But there's also one great element called the qualified charitable distribution that is really advantageous when it comes to lowering your taxes. Now, this is easy to do, and it comes from you taking your required minimum distributions. So instead of taking those, like we said, at age 73 or even 75 in the future, maybe we designate some of that money towards a charity instead. And so it does not come into your checking account. It does not become taxable. It goes directly to that charity. And what that will allow you to do is to lower your overall taxes, because we're not using that as income. Yes, we don't get the deduction, but maybe that allows us to do some other types of planning when it comes to how to work with your plan. So maybe we want to be doing more elements of the qualified charitable distribution this year, so that we can be doing more elements of the tax planning along with it. And if we use those all in tandem, you can really start to see now how we can start really figuring out a big map of your overall taxes and how we can be utilizing these different strategies to lower them in the future. gifting is another great strategy that you can be utilizing as part of your overall wealth plan. You see, when it comes to how to give to individuals, whether it's your children or your grandchildren, what you want to be doing is being able to give them money and leave them money that can be tax-free. That's a great actual strategy for gifting cash, but then there's many different investments that we can be used as part of the gifting strategies as well. And if done correctly, some may not even be, if they're underneath the rules and regulations, you don't even have to have a gift tax return owed, or maybe we actually want to be claiming more on the gift tax return so that we can lessen how much is part of your overall estate. You see, what we talk about here is many different elements to your overall wealth plan, but gifting can also be a great strategy that, one, you should be looking at, and the specific investments that you should be gifting as well. Well, as you can see here, there have been many different elements to what an overall taxable plan looks like here, and how we can be looking to improve your overall plan, but how we can be looking to decrease the amount of taxes that are owed. That's the element that we want to be working on here, how we can best be utilizing all of these different strategies together. But it all comes back down to knowing what's out there, knowing the benefits, and then how to use them correctly. And what we want to do then is put together a good strategy so it looks at where you're at today and where you want to go in the future. Now, those gaps that exist are talking about the tax gaps. So maybe you have too much money in a tax deferred type bucket and we need to be moving money into a tax-free bucket. Or maybe we want to have more taxable money. You see, that gives you options. When we have money that basically is in different types of buckets, we have options to cherry pick which ones those come from. And if done correctly, again, that's the power of using the tax codes to your benefits, and the different types of accounts, if done correctly, can help to lower your overall taxes in the future and actually help to improve the overall wealth plan and the probability that the money you have will last not only all of your life, but be able to be there as part of gifting and strategies for leaving a legacy for your family. Because you've made it this far, I want to celebrate you. You see, we've talked about a lot of different elements today, and there's a lot of people that actually start to go through and plan for their overall wealth plan and strategy, but never actually follow through with it. But you're different. And because of that, I want to offer you a special one-on-one consultation to look at all the different elements of your overall investments, the taxability of them, and how we can be working correctly to lower your tax burden today, tomorrow, and in the future, as well as how to improve your overall wealth plan. Click the link below, and I look forward to seeing you as part of a discovery meeting and a one-on-one consultation. For more tips and tricks on how to work with your wealth correctly, check out this video right here.